Hello, everyone. Welcome to the podcast for the month of February. I'm sure that we are witnessing nothing short than a market turbulence, and it's on investors' minds that how do they weather the current market turbulence that they are looking at. So let us see what, from a background or context perspective, what was happening in Indian markets. Clearly, it's been a cyclical slowdown, which is leading to correction of the overvaluation that persisted in Indian markets for some time now. Be it from a historical or relative standpoint, Indian markets were expensive. And this overvaluation was more pronounced in the mid and small cap space, owing to the high domestic flows through mutual funds, PMS, and also through direct retail and HNI investments. The recent decline in the Indian equity markets is not only expected, but was also warranted. Heightened economic activity of last 2 years is seeing some slowdown on a higher base. There were high expectations from the budget, but many ignored the fact that budget can only do so much. Immediate triggers to lift growth or address rural stress seem missing. The disappointment in the street flowed through in form of a steep sell-off in equity markets amid slowing, disappointing corporate earnings. Market expectations from corporate India had become lofty, which is nothing but a miracle of Excel sheets that just stretches growth upwards into the future. So if you see from the 52-week highs, we have seen about 11-12% correction in large caps, about 17-18% correction in mid caps, and about 19-20% correction in small caps. Uh, in terms of weathering this correction, our discipline of buying stocks when they hit our buy levels ensured we weren't aggressive buyers during times of lofty valuations. As a result, we had relatively high levels of cash in our funds. Recent correction has led to some moderation in valuations, but small mid-cap valuations still remain much above their long-term averages, whereas growth and ROE profiles still remain cyclical. Therefore, opportunities have broadly improved, but many are still away from our buy levels. So what also helped us is, some amount of cash, as I alluded to, in our portfolios. But to make the record clear, we do not take macro cash calls, and cash is rather a residual of our process. We were disciplined in waiting out for stocks which are not in our buy limit, and not chasing stocks with frothy valuations helped us protect downsides better in this correction. We rather trimmed or exited some of our positions when markets were riding higher towards its recent peak, owing to not able to justify prices even with our most optimistic assumptions, leading to bulging of our cash holdings. Importantly, our bias is to select companies with sustainable growth, generating good cash flows, and abroad taking into consideration margin of safety, ensuring reasonable valuations. And this ensured the decline was relatively less pronounced in our portfolios. So if you look at the fall, we have outperformed the benchmark indices in this fall in our active equity funds. Navigating small caps isn't easy. Liquidity and irrational exuberance can propel the price of small cap stocks, but earnings need to support eventually. Small and mid caps, SMIDs as they are called, are still relatively expensive and hence could be prone to earnings disappointment. We clearly may not be out of the woods just yet. Having said that, there will be pockets of opportunities that will emerge in the downturn, and we as active fund managers will be assessing their wide opportunities on merit and accordingly crafting our portfolios. We have strong research capabilities to navigate the enormous small cap universe that exists. We invest in companies offering growth while being mindful of valuations. We follow growth at reasonable price approach where prudent capital allocation helps drive better returns and reduces risk while growth valuation levers deliver upside potential as envisaged. We lay greater emphasis on governance and management quality to ensure delivery on expected performance. This is clearly important in the small and mid cap space because governance could lead to impact on us as minority shareholders. Bad governance will definitely have that kind of impact. and you may not achieve the expected performance on those companies. Emphasis on these factors have helped us in weathering near-term turbulence in the market, where our fall, as I alluded before, has been much less pronounced as compared to the benchmark indices. Liquidity in not so liquid market, not so emphasized aspect of small caps is the consideration on ownership and liquidity constraints, which is a peculiar trait of small cap investing. Given the fall in the market, liquidity has started to be relatively dearer as compared to the peak. And this is in the case despite the mutual funds flows still being positive. Given the challenging liquidity dynamics and the total size of small cap funds, only time will tell if this creates another leg of uncertainty for investors to navigate. We understand that large illiquid positions can become burdensome if redemptions aggravate, and hence liquidity needs to be assessed while building positions as that defines a fund's capacity. We at Quantum have liquidity and market cap as important considerations before investing. We are disciplined about fund capacity to avoid light size becoming a hindrance to performance. Good governance, sustainable growth, and reasonable valuations, along with adequate liquidity, is the mantra we follow at Quantum, which will not only help us through turbulent times, but also help us capitalize returns in a rational market. Small cap investing is clearly that spectrum of the market where investors need some real hand holding to navigate the large opportunity set that exists, but also it has its own dimension of risk. Probably with the recent correction acting as a reality check, investors may now be able to make terms with that in terms of getting a professional help in navigating the small cap space. We want to be that partner who will help you navigate this space well. And if you think our approach suits or are looking for this kind of approach towards investing, say, a portion of your portfolio, and here also investors need to be careful in terms of what kind of allocation to be crafted for small cap and mid caps, given the risk and that persists in that space. So overall, we would it shouldn't be a large allocation of one's portfolio clearly, and recent returns may have led to that kind of that kind of positioning for your portfolios, given that many investors look at recent returns and tend to allocate to that spectrum of the market more, which has delivered better returns. So clearly, it's a time that you evaluate your small cap exposures. Are you over allocated? Are you under allocated? And if you're allocated to the right funds or not. So with that, we are always there to be a helping hand in terms of crafting your positions and helping you within a fund that suits your needs. With that, if you have any questions, we'll be happy to answer any of them. So please get in touch with us on that. And with that, we'll sign off, but expect that you will navigate this space well, and we are happy to guide on that. Happy investing. Be careful, and we'll see you next month. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.